For the last 40 years, most of Houston's suburban growth followed the same playbook. Push west and north to northwest, build suburbs, extend highways, rinse and repeat. That formula created places like Katy, Cypress, the Woodlands, and Sugar Land, some of the fastest growing suburban areas in Texas. But that era is starting to end, and it's not because Houston ran out of land. In today's video, I'm breaking down how Houston's growth model is changing, which areas are positioned to benefit, which ones could stagnate, and what that means for you right now. Houston didn't stumble into growth. For decades, the pattern was predictable. Find cheap land west or north, build a master plan community, extend out the tollway, repeat. That worked because Houston has almost no natural barriers. We have no mountains, no oceans, nothing stopping expansion but infrastructure and politics. And the land was affordable. Developers could buy massive parcels in Fort Bend and Waller County for a fraction of what the land closer to central Houston costs. That's how places like Sugar Land took off in the 80s and the 90s, growing from under 10,000 people in 1970 to well over 110,000 residents today. Now, Katy followed a similar path. The city of Katy itself is still only around 25,000 people, but the greater Katy area, including Cinco Ranch, Grand Lakes, and the surrounding master plan communities, now supports well over 300,000 residents. Cypress experienced the same transformation, evolving from a largely rural land into one of the largest suburban population centers in the region, now home to roughly 200,000 plus people, depending on how you define the area. And that wasn't random. It was the result of a deliberate, repeatable formula. Acquire affordable land, build infrastructure, attract employers, and watch families follow the jobs and schools. That entire system depended on three things always being available. Number one, affordable land. Number two, land with highway access. And three, land that could be connected to utilities without that massive upfront infrastructure cost. For decades, Houston had all three of these in abundance. But that equation is changing. Not because land disappeared, but because the type of land that fits those three conditions is becoming harder and more expensive to develop. Those $250,000 starter homes that used to define the west and north suburban expansion are far less common in today's major master plan communities. The entry point has clearly shifted upward. So the question becomes, why is this happening right now? So picture this, a developer sitting in an office running the numbers on a new land deal in Katy or Cypress, and the math just doesn't work the way that it used to. That's not hypothetical. That's happening right now across West and North Houston. And it's not one single issue. It's multiple forces hitting at the same time, and together they're creating a completely different environment for development. Houston isn't out of land, not even close. There are still thousands of undeveloped acres. But what's becoming scarce is the type of land that actually fits the old growth formula. And we're already seeing this shift show up in real market data. In established suburbs like the Woodlands, median prices have softened from peak levels, and homes are taking longer to sell than during the pandemic buying surge of 2022, when properties were getting multiple offers and selling in days. That's a correction, but it's not a collapse. Some of that shift comes down to what types of homes are selling, price ranges, and even specific villages behaving differently. So this isn't a sign that the Woodlands is in trouble. It's a sign that the old growth conditions are changing. We're seeing similar patterns now in other major suburban growth corridors. Now in Sugar Land, the median pricing has eased from peak levels, and homes are taking noticeably longer to sell than they did during the pandemic surge. Fulshear shows another version of the shift. Prices held relatively firm, But guess what? Homes are sitting on the market much longer than they did just a year ago. And when you see slower absorption happening across multiple high-growth suburbs, that's not random. That's the development environment changing, okay? So what's happening right now is actually pretty straightforward. The land in those west and north suburban corridor isn't starter home suburban land anymore. It's premium land. Developers who used to target those areas are running the numbers, and they're realizing that they can't hit price points middle income buyers once qualified for. Much of the lower cost land near major job corridors have already been developed, and what's left often comes with a higher acquisition or infrastructure costs. So builders are left with two choices: pay premium land prices and build higher end homes for a smaller buyer pool, or look to entirely different areas where the math still works. Now, the second major constraint is infrastructure. In 2025, Houston commuters lost about 77 hours a year just sitting in traffic. That's roughly 6% increase from the year before. So a trip that should take about 30 minutes can easily reach 50 minutes or more during rush hour. And buyers are starting to hit what I call a commute ceiling. Most people just are not willing to drive 60 to 90 minutes each way just to afford a home further out. Yes, major projects are underway. The Grand Parkway is expanding. The corridors like 290 and I-10 are being widened, okay? But those aren't growth catalysts like past highway expansions were. They're congestion relief. They're trying to make the existing system work better, not push the development frontier further out. And it's not just the roads either. Utilities are the next constraint. The Houston region is planning for millions of additional residents over the coming decades, which requires major investments in water treatment, water capacity, and flood mitigation. Billions of dollars are being spent to upgrade and maintain these systems, but those projects are long-term and capital intensive. You can't just run water and sewer lines anywhere. It takes years of planning, engineering, and funding before development can even begin. So when you combine higher land costs with infrastructure systems that require massive investment to expand, you don't just get slower growth, you get a fundamental reset in how and where growth can happen. The suburbs that were once the default choice for the last 20 years are no longer the obvious value play. Fulshear and Katy used to be the affordable alternatives to places like Sugar Land. Today, Fulshear's median price is around $455,000 and Katy is holding near $375,000. That's not entry level. That's not even traditional mid-market anymore. That's premium pricing for a lot of buyers. For comparison, the Woodlands median price now sits at around $555,000 and Sugar Land is hovering around $500,000 depending on the segment. Clearly established premium suburban markets. Now, the gap between the move-up suburb and the luxury suburb has narrowed. And when affordability shifts like that, demand doesn't disappear, it relocates. And when we talk about the emerging north and northwest corridor in a minute, you're going to see similar master plan amenities for nearly half the price. The opportunity gap right now is massive. This is the inflection point. Developers are actively searching for the next Sugar Land, the next Fulshear, areas where land is still affordable. Homes can be built at a price point where buyers can actually reach an infrastructure that doesn't require massive upfront capital. And that search is pulling growth in a direction most people aren't even watching yet. So where exactly is it going? Well, I tell you, if you're trying to figure out where to buy in this shifting Houston market, this is where local insight really matters. We track development patterns, land movement, and infrastructure expansion in real time, and that gives buyers an edge. And by the way, I'm Travis, and my team and I help hundreds of families relocate to Houston each year. If you want guidance on which corridor fits your budget and goals, we'd love to help you make a smooth move here to Houston. The next wave isn't just west anymore, it's west and northwest. And this is where the data gets really interesting. Suburbs like Fulshear and Katy aren't just growing, they're booming. Fulshear has ranked among the fastest growing cities in the country in recent years, and Cypress's 77433 zip code was identified as the #1 most moved to zip code in the United States in early 2025. These aren't just small towns on the edge of Houston anymore. They're becoming the next generation of major Houston suburbs. So why is this happening? Well, because these areas still have what developers need: land that can be acquired at workable prices, utility districts forming to bring water and sewer capacity, and highway access that connects to major job centers. Look across the west and northwest corridors. Builders are still able to deliver homes in the 400 to 600,000 range in communities stretching from Fulshear and Brookshire to Cypress, Hockley, and Waller. Those price points continue attracting families relocating from higher coast states like California, Illinois, or New York. And infrastructure is catching up as well. The Grand Parkway expansion, improvements along 290 and I-10, and new utility districts are bringing roads, water, and sewer into these corridors, which is exactly what development needs to scale. In 10 years, places like Brookshire to the west and Hockley and Owale to the northwest will look a lot like Katy did 15 years ago. Master plan communities, resort-style amenities, strong schools, and full retail build-out. But right now, they're still relatively affordable compared to Houston's established suburban cores. And when you take a step back and look at the data, the pattern is pretty clear. The growth didn't stop, it just shifted. But here's the part most people are missing. There's a second growth wave happening at the same time, and it's much closer to the urban core. Now, developers are realizing something very important here. In many cases, it's now more cost-effective to buy an older home in an inner ring neighborhood, tear it down, and build new than it is to develop raw land on the far edge of the metro. Look at Bel Air. The city has invested over $50 million in new city hall and a public library. That's not maintenance, that's long-term positioning. In Houston's 3rd, 4th, and 5th ward, tens of millions of dollars are being committed through the tax increment reinvestment zone funding, along with public infrastructure investment to upgrade corridors and redevelopment areas. That's a re-imaging of what inner ring neighborhoods can become. The East End and Eastdue are doing the same thing. They're transforming former industrial and historic districts into a higher density residential, retail, and mixed-use areas through redevelopment incentives and infrastructure improvements. So why does this matter? Because in these areas, property value is increasingly tied to the land underneath the house, not just the structure sitting on it. The teardown market is real in places like the Heights, Bel Air, 3rd, 4th, and 5th Ward, and the East End. Homeowners who bought 10 to 20 years ago are sitting on land that now carries higher density redevelopment potential. That creates equity opportunities most people don't even realize are happening. This is smart money moving, not outward, but inward. There's another corridor that is in a much earlier stage, and that's East and Southeast Houston. This is long-term transformation that's just beginning, but the scale of what's happening is very hard to ignore. You see it in places like Mount Bellevue and Baytown to the east, and communities like Manville, Iowa Colony, and Texas City to the southeast, where population growth and large-scale development are accelerating at the same time. Mount Bellevue has been one of the fastest growing cities in Texas, with its population rising from about 7,800 in 2020 to over 10,000 by 2024, growth of more than 30% in just a few years. Major developments like the 1,500-acre Riceland Master Plan community, combined with strong petrochemical and energy sector employment, are fueling that momentum. Baytown now has a population of above 86,000 and continues to grow at a steady pace. Its economy is anchored by energy, manufacturing, and industrial employment along the I-10 corridor, and projects like the $75 million ExxonMobil funded sports and events complex are aimed at expanding tourism and long-term economic activity. But the southeast side is where residential growth really starts to shift gears. Manville along South Highway's 288 corridor is seeing rapid expansion driven by its proximity to the Texas Medical Center and Central Houston. Major master plan communities like Pomona, Meridiana, the Bellow Lakes, Sedona Lakes, Valencia, and Rodeo Palms are adding thousands of homes, modern amenities, and new retail development near the emerging Manville Town Center. Further south, Texas City is benefiting from its positioning along I-45 and a growing appeal as a coastal lifestyle market. Large developments like the 2,000-acre Lego Mar, featuring a massive man-made lagoon, and the luxury waterfront community Grand Cay Harbor on Moses Lake, are transforming what used to be overlooked territory into active residential growth zones. This is early stage growth. You're not looking at immediate inner loop style appreciation. This is more of a 10 to 15 year play, but the fundamentals are lining up. You have available land, job access, and infrastructure investment. East and Southeast Houston check key boxes: relatively proximity to the metro core, underutilized land, and growing public investment that opens the door for private development. That's how long-term corridors take shape. So we've covered three major emerging growth corridors, which raises an obvious question. What about the south and the southwest suburbs? I know some of you are probably thinking, does that mean these areas are done? Absolutely not. Markets like Sugar Land, Pearland, and Lee City remain some of the strongest established suburban anchors in the Houston metro. They offer excellent schools, built-out retail, medical access, and employment ties to the Texas Medical Center, NASA, Sugar Land's employment base, and the energy corridor. But here's the key shift. The explosive growth phase these suburbs experienced 10 to 15 years ago has largely passed. These are no longer emergent value plays. They're mature markets now. Sugar Land's median home value is, like I said, is around $500,000. Pearland sits at near $400,000, and Lee City is around $385,000, all above Houston's metro median and firmly in the established suburban tier. That doesn't mean appreciation disappears. It means that growth becomes steadier and more sustainable, okay? The days of rapid double-digit year-over-year appreciation in these anchor suburbs are less likely going forward. And as those anchor suburbs mature, growth pressure is pushing into the next ring, places like Richmond and Rosenberg. Richmond is seeing major expansion through master plan communities like Harvest Green, known for its agri-hood concept, Candela, and the massive 4,700-acre Austin Point project, all bringing modern homes, amenities, and new development momentum. Rosenberg is following a similar path with new communities such as Brickwater, Holy Ridge, the Preserve at Rosenberg, Evergreen, and Briarwood Crossing, offering parks, new construction, and access to Houston via Highway 69. This is how suburban growth evolves. The established core stabilizes, the next ring becomes the new development zone. So understanding where Houston is growing is about one thing, but what does that actually mean for you and your wallet? Let's make this practical. If you're planning to move to Houston in the next year or two, the safe bet suburbs are no longer as obvious as they once were. For the last 20 years, the default advice was simple. Move to Katy, the Woodlands, or Sugar Land, and you can't go wrong. And honestly, that's still true today. But Today, those areas come with higher price tags and slower appreciation potential compared to where Houston's next growth phase are unfolding. They're great places to live, just no longer the breakout growth plays they once were. The strongest long-term value opportunities are now shaping up in Houston's emergent and earlier stage corridors. That includes places like to the east, like Baytown and Mount Bellevue, to the southeast, like Manville, Iowa Colony, and Texas City. Redevelopment zones inside the city, like 3rd, 4th, and 5th Ward, the Heights, and the East End, and that outward expansion across the west and northwest through Fulshear, Katy, Hockley, and Waller. Meanwhile, in the southwest transition belt, places like Richmond and Rosenberg are benefiting as the next ring of development tied to Fort Bend County's continued expansion. These are areas that are still relatively affordable, seeing real infrastructure investment and positioned in earlier stages of the growth cycle than that of Katy and Pearland, what Katy and Pearland experienced years ago. Second, you have to shift your focus from today's amenities to tomorrow's infrastructure. Where is the highway expansions plan? Which areas are getting new utility corridors? Where are the school districts expanding or rezoning? Those are the factors that drive property values over the next decade. Okay, a home in a city with no infrastructure plan is at risk. A home in a major area with major public and private investment underway, that's opportunity. Third, if you're considering redevelopment areas inside of Houston, understand that you're buying into a transformation story. Neighborhoods like 3rd, 4th, and 5th Ward and parts of East Downtown won't feel polished overnight, but they offer proximity to jobs, existing infrastructure, and rising land values driven by redevelopment pressure. If you're comfortable with a more urban environment and want access to downtown without paying River Oaks or Westview pricing, those areas deserve serious consideration. And if you already own a home in Houston, this shift creates opportunity too. The reason people are moving further out, east, southeast, west, or northwest, is because they can still stay within reach of Houston's major job centers. Whether someone lives in Baytown, Manville, Fulshear, or Richmond, they're still tied to the employment hubs like the medical center, energy corridor, downtown, NASA, and major industrial corridors. Houston doesn't grow around just one single center. It expands into multiple directions at once. And that's exactly the cycle we're seeing play out again. Now, what does this mean if you already own a home in Houston? This shift creates a different opportunities depending on where you live at. Now, if you're in a mature suburb, places like Katy, Pearland, League City, or Sugarland, you're in a stable phase of the market. You're probably not going to see the explosive appreciation that happened during the earlier growth phases or the 21-22 frenzy phases, but you're also in some of the most desirable and established areas in the metro. Your value is driven by schools, amenities, and quality of life, and that doesn't disappear. It just means that your equity growth becomes steadier and more predictable. If you are in emerging corridors, places like Baytown or Mount Bellevue to the east or southeast along the 288 corridor into Manville and Iowa Colony, you're positioned earlier in the growth cycle. Development is still catching up. Infrastructure is still expanding, and the demand is being pushed outward from more built-out suburbs. If infrastructure continues to follow development, these areas could see some of the strongest long-term appreciation over the next decade. And if you're in the inner ring or area closer to Houston, the redevelopment wave creates a completely different kind of equity opportunity. Here, your property value is increasingly about the land underneath and its potential for higher density use. As developers and builders target these neighborhoods for teardowns and rebuilds, land values are rising independently of the structure, creating major upside for homeowners who bought years ago. And all of this comes down to one central truth about Houston real estate. Houston isn't running out of land. It's running out of easy land. The growth pattern that shaped the last 30 to 40 years isn't the same one shaping the next 30 to 40. Developers are pivoting fast, pushing further southeast and redeveloping inner ring areas where land is now more valuable than the buildings sitting on it. That means relocation decisions, investment strategies, and buyer behavior all have to adapt to this new reality. The days of simply following one highway to the next master plan community are coming to an end. The map is being redrawn right now. Buyers who understand these shifts will position themselves in corridors with strong long-term growth potential. Buyers who don't, well, they'll be paying premium prices in mature markets or chasing appreciation in areas that may have already peaked. So if you're thinking about moving to Houston, whether that's next week or next year, my team and I help people relocate here every single day. All of my contact information is going to be below and in the description or on the screen. You can call us, text us, or email us at any time. We'd be very happy to help you make a smooth move here and navigate this changing market with confidence. And if you want to avoid moving to the wrong areas of Houston, then check out the video that I've got linked right here. I break down the wrong areas to avoid and best value plays in Houston. And until next time, we hope to show you around town.